Hello investors, welcome to Simpli Stocks. So far around 10 to 15% companies listed in the market have announced their September quarter or Q2 results. So today in the first video of our Q2 FY26 results series, we will be discussing 6 small cap businesses that have reported very strong results. These businesses are from different sectors. We will understand their business models, review their results, and we will also try to assess what their future looks like. But remember, this video is not a buy or sell recommendation for any of these businesses. Please keep that in mind. With that being said, let's begin. The first business we will study is a micro cap or penny business called Sejal Glass. Recently, Sejal raised 94 crore rupees funding to reduce its debt. This fundraise happened at a price of 555 rupees per share, and you would be surprised to know that lead investor in this round was Sunil Singhania, who has invested through his fund Abacus. Since then, we too have been tracking this business for our community members. Sejal is in the business of manufacturing different types of glasses: toughened, laminated, insulated, decorative, as well as ceramic glass. Most of its business comes from infrastructure and real estate sectors. For example, you see tall glass buildings or large offices. The architectural glass used there is manufactured by Sejal. Until now, they had two manufacturing plants, one in UAE and other one in India at Silvassa. Recently, they acquired a company named Glasstech Industries, which added two more plants to their portfolio. There is significant scope for growth here with increased production and higher capacity utilization. Because of UAE plant, now 70% of their business comes from outside India. They had bought this UAE business in 2022. Before that, Sejal had been struggling quite a bit, but things have improved since this acquisition. Moving forward, the management of Sejal has set a target of 400 crore rupees in sales for this year, and in line with that guidance, their July to September results have been strong. Sales have increased by 69% year on year, and if we combine Q1 and Q2, total sales have reached 181 crore rupees in H1. So with respect to the target of 400 crore sales for this year, they have already achieved 50% of it in the first half. So it should not be difficult for them to clock the remaining 200 to 220 crore rupees in the remaining 6 months. Similarly, their net profit has tripled from 2.5 crore last year to 8 crore this quarter, and it is not mentioned here, but since production and capacity utilization have improved, profit margins have also become stronger. Net profit margin, which was 3.4% in H1 last year, has now doubled to 6.9%. Talking about the sector, there is a strong demand in both UAE and Indian markets. Real estate and infrastructure development is picking up speed. Apart from this, GCCs are also coming. GCCs are basically foreign companies which are setting up their offices in UAE and India. So overall, there is healthy commercial demand. Now, let us quickly look at Sejal's valuation based on this 400 CR sales guidance. This target represents about 65% growth. Now, as you can see on the screen, last year they did 244 crore in sales while earning 11 crore profit. Now, if we assume that the current H1 6.9% PAT margin continues for the full year, then Sejal's FY26 net profit can be around 27 crore rupees. That translates to a 1-year forward PE of 31 to 32. Although that is slightly a premium valuation for such a small business, but let us say if not 60%, even if they continue with 40% sales growth next year, and if net profit margins go to around 7.58%, then these two can be two big triggers for Sejal. Also, they have 150 crore rupees in accumulated losses from tax point of view. So over the next 2 to 3 years, they will be getting tax benefits as future profits will be set off from these accumulated profits. These tax benefits will result in higher profit margins, net profit margin in the short term. So if you are interested in this business, you will need to keep a slightly long-term outlook here. The next business we will study is Manorama Industries. Manorama serves the bakery, confectionery, chocolate, and cosmetic sectors. This company manufactures specialty fats and cocoa butter equivalents or CBE, which are used as replacements for cocoa and other fats in these products. So FMCG companies get a cost benefit by using Manorama's products, since pure cocoa is obviously expensive. So in a way, Manorama is a proxy player for the FMCG sector. They produce these fats from mango, shea, and sal seeds. Their business model works in such a way that they source seeds from tribal areas and collection centers in Africa and India and then process them into these fats. Talking about customers, Manorama supplies its products to companies like Mondelez, which owns brands such as Oreo and Cadbury, Ferrero, Nestle, L'Oreal, and The Body Shop. Around 60% of their sales come from exports. Manorama has a fully integrated plant in Raipur. Fully integrated means that from extraction, refining to fractionation, all steps of manufacturing are done within this single plant. The company has also recently expanded its capacity. Furthermore, in Q3, in these months from October to December, they will be doing maintenance and upgrading their plant, which will increase their capacity further by 30% from 40,000 metric tons per annum to 52,000 metric tons per annum. They have also purchased 20 acres of land near their existing plant for medium to long-term expansion. In this same presentation, you will notice another very interesting point. It has been mentioned that the company has revised its sales target for this year from 1,050 crore rupees to 1,150 crore. That means earlier they were targeting 35% sales growth, but after a strong H1 performance, they are now aiming for 50% growth. This is a very positive sign. Let us look at their results now. In Q2, or basically July to September months, their sales have grown 65% year on year and the net profit has increased by 105%, or we can say it has almost doubled. EBITDA margins have expanded significantly. You will see from 23.1% to 27%. Even in Q1, their numbers were very strong. So overall, H1 sales growth is also at 65%. Here is another interesting detail. You will notice in 6 months, they have achieved 613 crore in sales. So if we assume that in the next 6 months, they just continue with this performance, they will be able to easily meet their 1150 crore target, possibly reaching 1225 CR in sales. That means around 60% growth, even more than their revised guidance. Hence, we can say these are very strong results. Now, let us do a quick valuation exercise for Manorama. It is mentioned here that in the first half, their net profit was 106 CR. So, if we analyze it or basically multiply it by 2, the full year profit can be around 210 crore. The company's current market cap is 9,000 crore. That means the forward PE comes out to roughly 40 to 45, which is a very reasonable valuation. So at a forward PE of 40 to 45, you are getting a FMCG or proxy FMCG business growing at 50 to 60% rate. On third position, there is a very interesting business which is not held by just one but actually two ace investors. The company is S.G.Finserve, and in it, Madhusudan Kela is holding 1.7% stake while Ashish Kacholia has 1.1% stake. S.G.Finserve is an NBFC. It is engaged in dealer financing, vendor financing, and bill discounting. Here, let us take 2 minutes to understand their business model. So, imagine you are a small business or MSME that supplies auto parts to Tata Motors. Now, Tata Motors will pay you after 30-45 days for goods you have supplied to them. But since you are not a big businessman with unlimited capital, you'll need money, right, to buy more inventory, continue operations, and carry on sales in future. That is when you will go to S.G.Finserve. Since SG knows your customer is Tata Motors, a big reputed company that will definitely pay you, right? So they will lend you money in advance and you will receive payment from Tata Motors 30-35 days. When you receive that payment, you will pay back to S.G.Finserve. So S.G.Finserve provides financing to suppliers and dealers of large, trusted, reputed companies. As you can see here, they work with suppliers and dealers of major players like APL Apollo, Adani, Tata Motors, Tata Steel, and Oppo, among others. Because of this model, their NPAs or loan defaults are nearly zero. So, from a business model perspective, S.G.Finserve has a lot of potential. As India will grow and industries will expand, the demand for such financing will also increase. And since the company's base is also small, it can grow very fast. Now, I have told you all the good things about S.G.Finserve, but there have been some challenges too. What happened is that last year, RBI introduced several restrictions on SG, due to which SG had to cut its business almost by half. As you can see, from January to September last year, their AUM, interest income, and net profit all fell. However, in the past 1 year, SG has made a strong recovery and the business has even surpassed pre-regulation levels. Their results are not comparable because of those disruptions, but quarter on quarter, their performance has improved. The business is now moving in a positive direction. Their AUM or assets under management have grown to 2,900 crore approx. AUM or loan book is the money that a bank uses or NBFC uses to lend forward. Sequentially, there has been a 15% quarter on quarter growth. Similarly, disbursements or basically new loans given have increased by 11% quarter on quarter. But see, SG is a new model and management has also changed recently. So if you are interested in this company, you should approach it gradually. Further, on a cautionary note, you will see that management has revised its profit guidance downward. Earlier, they were guiding 150 crore net profit for this year. but now it has been reduced to 125 crore. However, this is not a big concern, I would say. The long-term growth momentum remains strong, so this small downgrade can be overlooked. And as I mentioned, their AUM is now almost 2,900 CR. Just like we track sales growth in other companies, in finance companies, we have to track AUM growth. So SG's management has guided for 4,000 crore AUM by the end of this financial year and is targeting 6,000 crore by FY27. That translates to an impressive 60% CAGR growth over the next 2 years. And as growth will come, margins and return ratios should also improve going forward. So S.G.Finserve is an unconventional, fast-growing, early-stage business model that you can definitely study on your own. If you are liking this video so far, then do give me a thumbs up. This is my only motivation behind bringing such high-quality research videos to you for free. And yes, you can also subscribe to our channel, Simpli Talks, where we bring multiple such videos every week. Let's return to our discussion. The fourth business we will study is Zota Healthcare. We have been covering Zota in our community since April. This company is working on PM Modi's mission of providing affordable generic medicines. Zota runs pharmacies or medical stores for generic medicines under the brand name Dawa India. Just like S.G.Finserve, this business model might also be new to you. So let us take 2 minutes here to understand Zota's business model and what these generic medicines actually are. So when a drug or medicine is developed, let's say Cipla or Mankind spent 4 to 5 years on research, testing, and finally created a drug. What happens next is that since pharma companies spent crores of rupees on the research and development of that single medicine, the government gives them protection in the form of patent. This means the formula of the drug and its research will be protected from other players. For the next 10-20 years, only that company can manufacture and sell it and earn profits from it. No other pharma company can copy or reproduce that drug during that time. But what happens after 20 years? The formula has to be disclosed to everyone. By now, the company would have already earned enough profits in those 10-20 years by selling it exclusively. Now, other companies can also use the same formula to launch their own brands in the market. The benefit of this is that, firstly, the price for consumers or patients decreases. Secondly, the pharma companies will also do some additional research on that drug, which can possibly result in better versions of that drug. That's how the entire pharma sector works. For example, take paracetamol. There are brands like Dolo, Sumo, Calpol, but all are same medicines. Dolo is made by Microlabs, Sumo by Alchem, and Calpol by GSK. All three are sold in the range of 25 to 35 rupees for a strip of 15. Paracetamol is an inexpensive medicine, so you might not catch a big difference between 25 and 30 rupees. But in other cases, one company might be selling a medicine for 2000 rupees while another sells the same drug for 3000 rupees. The price difference depends mainly on marketing. So once the patent of a drug expires, that drug is called a generic. Generic medicines are 30 to 90% cheaper than branded medicines. And you might think there are only 5-10 such medicines in the market. But listen to me carefully. As of today, in India, 90% of the medicines sold are generics. That means you can easily buy these medicines at up to 50% discount. And not just in India, even in the USA, whose healthcare system is considered highly advanced, 90% of the medicines sold are generics. Right now in India, there is a huge awareness gap because many people don't even know that by switching to generics, they can significantly reduce their medical expenses. So Zota runs pharmacies or medical stores specifically for these generic medicines. They are expanding very rapidly. In the last 3 months, they have opened 310 new stores and they now have a total of 2055 medical stores across India. Zota had set a target of opening around 1000 stores this year. They have opened 163 stores in Q1 and now 310 in Q2. So within the first half of this financial year, they have opened 474 stores, completing almost 50% of their annual target. Their results have also been good, but because of such fast expansion, Zota is currently in losses. But what we need to keep tracking is whether the business is moving in the direction of profitability or not. Because see, what happens during such fast expansion is that you have to bear costs upfront of opening stores, hiring staff, etc., while sales come later. If you are growing fast, profitability will take a hit. Now, let us look at their results. Their sales have grown 92% compared to last year, which means they have almost doubled. Their gross margin has reached nearly 60%. An important point to note here is that their EBITDA margin, which was negative 0.5% last year, has now improved to positive 6.2%. This is the second consecutive quarter where the company has earned profit at the EBITDA level. That's why even though sales grew by 92%, the company's losses did not increase at the same rate. They only went up by 33%. So as sales continue to grow in the coming quarters, losses will gradually reduce and the business will eventually turn profitable. The next business we will study is Thyrocare Technologies. Thyrocare is a healthcare diagnostics company. Their main business is of running diagnostic labs, which is where most of their sales come from. They have 37 labs across India, and to operate these, they have set up a network of more than 10,100 franchisees. The model works like this. Say a doctor tells you to get a blood test done. You visit a Thyrocare franchisee where you give your blood sample. That franchisee then sends the sample to the lab, and within a day or two, you either collect report from the same franchisee or you receive it online. Thyrocare operates on a B2B model. Its sales don't come directly from customers or patients, but they come from franchisee partners or labs, clinics, and hospitals. For Thyrocare, the actual customers are these franchisees or institutions, not individual patients. The tests are performed by Thyrocare, but the reports are often branded under the names of franchisees or hospitals. Compared to other players, Thyrocare's pricing is very competitive, which has helped it to establish a strong position in the industry, especially in smaller towns and cities. Talking about the sector now, the post-COVID years 2022 and 2023 were weak for diagnostics companies. But over the past 1 year, the sector has recovered well. Overall, the diagnostics market is growing at 10% rate annually, but companies like Thyrocare and Dr. Lal Path Labs are growing much faster at over 15% rate as they continue to capture market share from small regional players. Now, looking at their results on both half-yearly and quarterly basis, they have shown strong 24% sales growth. Their profit has increased by 45 to 46%. And since profit growth is higher than sales growth, it indicates that the business is experiencing operating leverage as well. In my opinion, Thyrocare is the best player in the diagnostics space right now. Its management has consistently delivered better than promised performance. According to my estimates, Thyrocare can easily achieve 20% sales growth, even though its management has guided for only 14 to 16% sales growth. They are saying that this year, fever-related cases have decreased 26% compared to the last year. And since October to December is the peak season, this December quarter might be weaker. So you need to keep that in mind. But overall though, Thyrocare is a good business that you can study further on your own. The sixth and final business that has posted very good results is Anand Rathi Wealth. Anand Rathi operates in the mutual fund distribution business, and most of its customers are HNIs or ultra HNIs to whom they sell these mutual funds and also provide other investment related services. Anand Rathi currently has almost 90,000 crore rupees of AUM or assets under management, which is the total money invested by their clients through them. They hold around 1.4% market share in the mutual fund industry. This is a relationship based business where relationship managers or RMs handle client accounts. You can take them as trained, experienced advisors who maintain client relationships and guide their investments. Currently, Anand Rathi has almost 400 relationship managers serving around 12,800 clients approx. Their AUM has grown by 22% year on year and number of active client families has grown 16%. These are impressive numbers because especially considering that the market has not moved much in the past 1 year and mutual fund inflows, that is new investments in the mutual funds, have also slowed down. Yet they have managed to grow both their client base and AUM. This 22% growth in AUM shows us that their relationship manager network is very strong as they could successfully encourage clients to continue investing even in a sideways or weak market. Continuing in that direction, their sales have increased 23% year on year and their net profit has grown 31% in this quarter. They are also making good progress on their full year guidance. The company had projected 1175 CR in sales and 375 CR in net profit for this year. And within 6 months, they have achieved half of those targets. Their AUM has reached 91,500 crore mark and the company has guided it to touch 1 lakh crore mark by the end of this year. So as a business model, Anand Rathi is a very consistent growing company with a strong moat. You can understand its potential this way. You would know that Nifty has historically given about 12 to 15% CAGR return, and Anand Rathi's AUM grows roughly at 15 to 16% annually, just because the market itself goes up. Add another 5 to 10% from new inflows every year, and you have a strong, consistent compounder that can grow 20 to 25% annually for many years. That is why you will notice this business trades at a premium PE ratio of 75 to 80. One reason is the strength of its model, and the other one is that its management has consistently delivered growth in both good and bad market situations. That's why you can't reject a company just because its PE looks high. You need to see the growth rate, size of the company, and the strength of its business model, because market assigns a premium for all these factors. That being said, current PE is still slightly expensive though, so you should analyze that for yourself if you are interested in this business. Otherwise, you can also keep it on your radar for the future. The main risk here you need to track is the RM attrition, whether relationship managers are leaving the company, because as I mentioned, this is a relationship driven business. So risk here is that if an RM leaves Anand Rathi to join another firm or they start their own business, some clients might follow them, leading to AUM loss. In the first half of this year, only 4 experienced RMs left the company, and even there, they have managed to retain 82% of the AUM handled by those RMs. Now, this video is about to end, but if you have not liked this video yet, then please do it now. Also, you can subscribe to our channel. Your likes and subscribes are our only motivation. I'll see you in the next video. Happy investing.